So for today's class, let's start from shared service approach. This is for the continuation of finance function with the help of technology. So what is the shared service? If someone said shared service, what would you think about it? What do you think shared services are? Because I think we've had quite a number of them in our current day-to-day activities. Anyone has an idea? Anyone, please? Okay. I usually prefer when you give a try because really it becomes much easier for you to understand it. But since no one is volunteering to contribute, then let me explain it further. So shared services, here we have we have a consolidation of a particular operation by the business. So we can have, okay, look at it like, let me give an example of URA. URA could be a consolidated service for all the local government sectors. For example, if you want to pay for let's say your tin, you could pay to URA, and then URA is the one to notify other people or by sending them maybe payment proof or something. If you want to pay for, let's say, your driving permit, you could pay to URA. If you want to pay for let's say registration of a business, you will pay to URA. Any service that you want to pay to, any service that you want to pay for in a local government sector, the money would first be recognized by a particular unit, and then it goes to the intended sector that you want to pay to. So it means instead of every, I don't know if that gives the best example, but I'm hoping so. Or we can say the Ministry of Finance. The Ministry of Finance can do the planning, can do the budgeting, can do the allocation of funds for all the local government, let's say, sectors. So it means that if you're, let's say, Ministry of Education, you will not have a sector for doing finance management, because you will not need it. You're already sharing that service from a particular pivot point, which is, let's say, the Ministry of Finance, or let's say maybe URA for collecting or receiving your finances. So it means that now your costs that you would be incurring for having finance department in Ministry of, let's say, Agriculture, Ministry of Education, you have a finance department, Ministry of this, it would minimize the costs that you would incur, because now you would not have a lot of staff that you will need for a particular sector, since you have someone that is offering the service across all of you, or across all the government sectors. That was an example. So with the shared services, you have one service center that will do the management, or will offer for you, will do it is like responsible for, let's say, all the costs that you will need to incur for that particular service. And then now for the different companies or the different organizations that will be still in need of that, will not have to go through incurring the same costs, but rather they will transfer that service to the unifying center that is handling that particular part. Does it make sense?
Yes.
Okay. So what are the advantages that will benefit from having a unified or having a central service center that is giving us those assistances? Like we said, one, it will be cost saving, because you will not have to have duplication of these different roles in all the different organizations or subsectors that you're having as an organization. And then it also increases efficiency. How? You look for the best skilled members, have them recruited. So now it means that for the other different branches where you would not have had a chance to afford the skilled personnel, you can still enjoy the qualified services that you're getting from the center, the service center, where you're receiving those particular what you've assigned them if it's finance, for example. So it means you can get finance advice when you're doing budgeting, when you're doing planning, when you're managing your finances, when you're doing reporting. You can be able to benefit qualified or informed knowledge from the experienced or best experienced team that you are all getting information from, other than having unqualified members in the different subsections simply because you would not afford the high cost. Then it also increases flexibility, because now we can be able to have a help desk that will assist the different I can call them maybe subsidiaries or different organizations that are sharing from the same source of the service center. It also helps in improving business decisions, because now you will focus on the main business activities, other than focusing on things that would be that can be catered for by the other unified service center that we've put in place. Instead of you having a problem of how can we have filing of, let's say, returns on time, how can we have our reports prepared on time, that will not be your problem. So now it means that you can focus on other things that are more important, like how can we diversify our products, how can we reach to new markets, what can we do. So you focus on things that can generate more income for you, or that are more primarily more important to you than than something that you can be able to get assistance from a different center. However, there are disadvantages that you will incur. The startup costs will be very high, because now you have to get the best team, or there could even be there could be many to be able to serve all the different number of branches that you're having. So it may be difficult in terms of accumulating or having those costs together to be able to have that function starting to operate. And then there could be also a challenge in terms of not having control over the service that is being offered to you. If the person says, like, I will give you feedback in the next 24 hours, you don't have control. It means you have to wait for the next 24 hours. But if they were in your region, let's say if this is your office and you had the finance department in there, it means you can go and say, please help me check through this, I want it now. And then they can be able to leave everything they're doing and focus on that for that short moment. But now when this person, because now you're sharing different organizations and they have maybe different challenges they are working on at the same time, you will not have control if you want something as soon as possible. The other challenge is that we incur when we have such an arrangement in place is that the costs may be overestimated. if we say we're contributing this particular amount, or maybe you say for us in this year we aim at reducing the costs for the organization. For it will be much difficult because you have a fixed, let's say you have a fixed amount that you have to contribute to that particular center that is offering you the services. So the potential reduction for those costs could be difficult on your end, and then you have to take it or leave it. So those are some of the challenges that we face. Also, the other is maybe difficulty in tailoring your services from what they are offering. You may want something that is more tailored to you, or you could have a problem that needs someone to give you much attention and try to bring a solution that is much in line with what you're facing. But then for them, they are giving a generic or a solution that is basic or overall. So it means you'll miss a chance to have someone look into your situation much critically and give you a solution that is much tailored to what you're facing or going through at a particular moment. So those are the main disadvantages, but there could be also much more that we face as an organization if we are having a unified service center for, let's say, the finance, for the finances. Okay, are we together? Do we still continue? Any questions?
I have a question.
Okay.
I really did understand how it brings about increased flexibility, because I feel like it will be difficult for them, since I feel some people will be hard to adapt that change.
Adapt to which particular to which change?
So remember, because you were saying that it's like you talk about this point where, okay, people are going to come together, so they're sharing this service.
Yes.
Am I right?
Yes, you are.
So if there are, okay, some people might, I feel like some people might reject it in the organization or in different organizations. Okay, more light on increased flexibility.
Okay. So increased flexibility, how it comes about. Let me give an example now of if we have a help desk that tackles maybe different challenges that come through. So it means you can have someone who is solving problems on how to, let's say, increase cash flow. Another one is solving problems on how to analyze data on which projects to invest in. Another one is offering a solution on okay, the different, assuming we break down all the roles that we do as the finance department. So there is someone that is put in place to solve that particular role, so they are very well experienced. So it means for you as the company who is benefiting from the central service center that is put in place, it's much easier for you. It's okay, you will feel there is flexibility in the organization. How you can get a solution on all the different dynamics, so it's more flexible for you to solve different problems with a different service team in place, vis-a-vis if we had a finance department, for example, and this finance department is we've hired, okay, not very much expertised people, but they are okay, they have the knowledge, they know how to do something. But then you have a challenge that has come up and they do not have much knowledge. It means you have to go recruit someone who can be able to solve such problems for you, but which will take more time. That will not be easy for you in terms of switching roles, in terms of having a more qualified person on the team, in terms of even getting that person coming through. So it will be a little bit stiff. But if you're benefiting from a particular same unit, or look at it as an organization that has, let's say, 10 different branches, and all of you are benefiting financial services from, let's say, the head office. So it's much easier, or it's much flexible for all the other 10 to be able to submit and get feedback in because all the 10 will have different challenges, maybe based on the locations, based on the clientele, based on any, depending. But now, because you have a unifying sector whereby you can go submit your challenges, have them look through what you're facing, and then they will get back to you with a solution, or with let's say a plan. It makes it much easier for you to be able to focus on things that you would want to focus on for that day, and then that person is helping you with finding a solution for the challenge that you had submitted. So that's how flexible it is. I don't know if it brings more highlights, or you still don't get it well. Okay. Any other questions? Okay. Any other? Okay. So financial expectations to stakeholders, this is quite basic and easy to understand. I think that one doesn't need much explanation. We can look at funding strategies. So every company, as it is trying to put in place a funding strategy, what is their aim? What do you think is their aim? Why do you think a company would really be interested in having a funding strategy?
I would think to help in different activities, such as in financing, the, in helping, in helping, like the strategy, how maybe for it to be successful.
Did you finish the point, or you are still adding? As if you are still adding on the point.
Okay, I was done with the point.
Okay, please repeat. I didn't get it so well.
Like, I would say that it would help maybe the organization in aiding different activities, such as the success of the strategies within the company.
So aiding different activities is the point, right?
Yes.
That's a good trial. We want to make sure that we have enough money to be able to support the different activities we're trying to put in place, which is actually true. If you're trying to fundraise, or we're trying to look for finances, what is the use of the finances in the first place? Because we want to achieve maybe certain different goals. And as we're looking for finances, we're trying to look at something that is mainly based on the cash flow of the company. With the cash flow, we're trying to ensure that we have as much money available, as much resources available as possible. And how can we get those resources? One, through minimizing the costs. We want to ensure that we have less expenditures and much more resources available to be able to support the strategies that we're trying to put in place, or that we're trying to fundraise for. Is someone saying anything?
We are not hearing you very well.
Sorry. And now, can you hear me? Can you hear me? Patricia, can you now hear me? Jen, can you hear me? Cecilia, can you hear me? Hello?
Yes.
Okay. So, I was saying, having in place a funding strategy, our main aim is to ensure that we have as much resources as possible to be able to do what we entail to do, or what the goal is. So we're focusing on having low costs, so having less expenditure, so that the cash flow, so that the resources which are available can be sufficient enough for that particular project. So what influences this strategy development? So when you're trying to look at how to finance an organization, to have different things that will affect that. So it could depend on different things. For example, is the company going to be a privately owned company, or is it going to be a listed company? So now you know, if it's a listed company, it means we're going to get money from different shareholders. What will be their different contributions? If you're an individual, how do you want to get the money to be able to finance yourself? Is it going to be through a loan? Are you going to have a partner? Are you going to have maybe selling of maybe some assets so you can get money? How do you want to operate? That will aid you as you're trying to put in place a strategy that can help you raise money. Then also the attitude of the owners or the senior managers towards the risk, towards different risks. If there are more risks that are involved, it means now your strategy will be different from someone who has less risks that they incur or that are involved in their financing strategy, or in their financing goal. So how does that impact? If, for example, you're going to take a loan and the loan has a high interest, it means it's going to affect one on the profitability of the company. It's going to put the company at a risk of losing maybe anything, maybe the collateral or what. So it means you will want to, that kind of risk that is available is what is going to aid you now on whether to take that particular financing route, or maybe you're going to focus on looking for a different financing strategy in place. So we consider those: the company, if it's going to be either private or listed, or what is the attitude of the managers towards the risks that are involved in raising the finances. So there are different major influences on this strategy. If your company is highly geared, it means the company may wish to avoid high levels of business risks. Otherwise, if the gearing gets much more or exceeds the 1-to-1, it means it will put a company at a disadvantage. Then we can also look at influences from the ownership may be changed to gain access to different sources of finance. If you're a private company and you don't have enough resources, but you can say, I'm willing to take on a partner, it means if you are having 100% shareholding, now you're going to have to lose, let's say, 40%. You're going to lose some of the ownership to a different person that is going to give you the funds. Then also look at the strategy focused on the acquisition will be driven by the need for a high level of growth, and as a result, other strategic possibilities may be neglected. So those are the major influences that we will have when we are trying to get a funding strategy in place. So we have a phase of development. So in the phases of development, we have a table here that shows us. It uses the BCG framework. I don't know if you remember it. We looked at it earlier on in chapter 13. Yes. So we're trying to link between the funding and the dividend strategy for given phases of development. If we have a problem child, what can we consider vis-a-vis if we have a star, or if we have a cash cow, or if we have a dog? Do you remember what these mean? Does anyone have a clue? So with a problem child, when we are at the induction or we are at the introduction stage, we're looking for funding. What things can we consider? It means we can have venture capital, but are there going to be any dividends because you're at the start? Of course not. We're just starting. But if we have a star, it means funding can come through equity, which would be difficult if it were a problem child. And will there be any dividends? You could get nominal if you have any at the end of the financial year. After you've done the balancing and you said there is any profit remaining, yes, you can. And if you do not have, it means you will not share the dividends for that particular period. But if it is a cash cow, especially cash cow is usually when we're at maturity. Funding we can have both from debt and equity, because now we have the muscle to accommodate also the debt. And will there be dividends? Usually there will be dividends, because now we are at a maturity stage, we are doing operations, we can be able to make profits at the end of the year, so the dividends will be high. But now if you get to a point where you begin to decline, which we call the dog, getting finance will be difficult from debt and also equity. So it means you can be able to get finance from secured debt, where you will now you will have something for security, and dividends will be reducing, or they will be declining, because now the business is also on a declining slope, different from when it was growing from a star to a cash cow. So what are the are we together there before I proceed?
At first you were on and off when you were explaining, but I didn't hear you clear.
Okay, so I was saying, if we're in an introduction or induction phase of an organization, which we call a problem child, is it easy for us to get funding? Or where can we be able to get funding from? We can get funding from venture capital. Will there be dividends? We're just starting. Do you really expect us to have dividends in place? Most probably it will be a big no, because we don't have anything at the start that we can be able to give to you in terms of profit. But as the company grows, it goes from this phase of introduction and goes to the growth stage, which we call the star. We can be able to raise funding. Yes. How? Through equity. It means now different shareholders are giving us their monies to operate the business. Are there any dividends? It is possible to have. You can get, or you may not get at the end of the period. If you've just had any profits, it means you can share the nominal dividends. Then if we move from that phase of the growth and then we get to a project market maturity, whereby things are good, we're okay, We can be able to raise funding through debt and through equity, because now we have the muscle to take on debt, or we can also be able to sell more shares or register new shareholders, and then we can be able to get equity. Are there dividends? Of course, most likely yes, because at maturity the project has broken through. We have profits that are remaining at the end of the year, and it's high likely that we shall share dividends at the end of the period. But once we cross that stage and then we get to a place where the company or the project is declining, what we call the dog stage, getting finance now, it means it's difficult for you to get finance from equity, because now who wants to buy shares of a company that is collapsing? Very difficult. So you can only get finance from a secured debt. Can you be able to get dividends? Yes, you may get, but the dividends will be also falling. If the company is not is not performing so well and it's declining, also we expect the profits to be declining, so the dividends will be declining or falling. Is it now more clear?
Yes, it's clear.
Okay. Okay. So what characteristics do we have in place of the sources of finance? What do you think are the things that we would look at if we are looking for places to get finance from? Anyone? Things that we consider, even if it's you going to get a finance from a friend, it's not yet end month, you have something that has come but it's really urgent finance and you don't have, what would you consider before getting that money from a particular source?
I would say the the level of the condition. For example, let me say if an organization wants to get maybe finance from a bank, it may consider the, 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 the different rates the bank rates, how it's
So
going to be changed in terms of the rate. Then also maybe for a person or an person, he or she might consider the period. Maybe for the person might say that I want within maybe 2 weeks, when for you maybe you can afford like after 1 month. So the level of different conditions.
Thank you so much, that's very correct. Any other trial? Okay, so what you said was very correct. We will look at the conditions, for example, the interest rates that are going to be given to us. Those are very crucial and important. We don't want to go for loans that really are are having very high interest rates. You're borrowing 10,000 for one day, and someone says tomorrow you give me 20,000, almost 100%. So you don't want to go for something like that if you're an organization. And then we also look at the time frame. How much time are they offering? Are they giving us 1 year? Are they giving us 1 week? Is it 5 years? How much time do we need this finance for, and how much is the other person willing to offer to us? We also look at the costs that are incurred in the process of getting these finances. What do we need? Maybe they need visitation costs, they need different costs that you will have to incur in the process. If they are very high, you would want to opt for someone who is a little cheaper. And then the size of the company, how big are we? Or if you're the one offering finance, how big is the company? You don't want to offer money to a company that you are not sure is going to be existing in the next 1 year or few months. So if it is a big company, then you're sure that this company will surely survive to pay me and will be able to pay me my money back. Or if it's a small company, then we can give them maybe less money, since we're not very sure of their stability. Then also look at the gearing ratios. How indebted is this company? Is it having too much debt? If that is too much, it means that you're at a risk of not receiving your payment back. But if the company is not so much indebted, it means they can afford to clear your payment and then continue in their operation. So those are some of the main things that we will consider when we are trying to look at things to consider before getting finance, or things to consider as we're offering finance to an organization. To bring this. Okay. So the different types of capital that we can get. One, we have equity financing. What is equity financing? Someone who has done financial management. What is equity financing? Anyone has an idea from financial management, advanced financial management? I think that's where they're very common. Equity financing, anyone? None has an idea.
Hello?
Yes, hello? Hello? Internet yayanga. N'umuriro gwanje gurikwa. So with equity financing, mainly we look at things to do with shares. That's how we get money from. Either we're issuing different shares, new shares, that is from ordinary shares. We're having new shareholders coming into an existing company, paying money, and then they can be able to have ownership attached to them. Or we have preference shares. Sorry. So what are preference shares? They're different from ordinary shares. Preference shares, here we're giving to already existing shareholders. Or now with ordinary shareholders, these ones share their profits at the end of the year, but they only share their profits if the company has made. They only share dividends if the company has only made profits. But with preference shareholders, these are types of shareholders whereby whether the company is going to make profits or is not going to make profits, they have a fixed dividend that is assigned to them and it has to be paid. So if you skip this particular year, maybe you've made losses in this year and you make profits in the next year, you will have to first clear their previous balance of the preference shareholders plus the current balance or the outstanding dividends for the current year. For them, they must get their dividends. So it's almost they are less risky, not like ordinary shareholders. So when you're raising money through equity financing, you offer these kinds of shares to the either existing shareholders or new shareholders, based on what is preferable, what is available, and then you can be able to get money to be able to run your day-to-day activities. Then how else can we get money? We can be able to raise funds through using retained earnings. The retained earnings are more like savings. If we made, let's say, 1 million profits last year, and out of that money we said we'll have retained earnings of, let's say, 500,000. So we come and instead of going out to look for external sources of finance, we use the profits that we saved in the previous periods and then we can use it to finance the projects or the company for what they are aiming at financing now. Then we can also issue ordinary shares. So with issuing ordinary shares, of course, now we're targeting new people coming into the organization through the stock exchange market. We list, if we're a listed company, we have we are under listed stock market. So we come and tell them that we have these shares that are on offer, and this is the price per share, and then they will help you to publicize it, and then have new members coming in to buy shares. We've seen this, like for example with Airtel, when it was trying to get listed, they were issuing ordinary shares. So you buy the shares, you pay the company some money, and then you remain with a right, or you'll have a right to the number of shares that you've bought. So you can be able to share dividend based on the percentage that you've purchased. Then we have raising equity finance. We can raise equity finance in two general methods. Sorry. So like what I was trying to explain here, when we are raising equity finance, you can raise it either by by issuing new shares, or by reinvesting the profits that we had saved before, which we talked about to be the retained earnings. So those are the different ways we can be able to get money or raise finance through equity financing method. We can either issue new shares, we can use retained earnings. When we're issuing shares, or when we're looking at having shares, we can either have ordinary shares or preference shares being given out to the investors or the shareholders. Then we have long-term debt. Here, long-term debt comes through from financial institutions. For example, you can go to the bank and you have a 10-year or 5-year debt. Long-term debts are usually debts that go for more than 1 year. We classify them as, those debts will be classified as long-term debt. So we go to a financial institution, we do our negotiations with them, how much money we want, how much time we need, what interest can be given to us, and then they will give you a loan note, and they will give you financing for the particular period that you've requested for. So there are different advantages, of course, that you get, and disadvantages from having a long-term debt, depending on the interest that you're getting, depending on the costs that you have to incur. But the main advantages that we get, that we benefit, is it is very flexible. Instead of having if we have instead of having very many more shareholders that you cannot reduce over time, if you have debt, it reduces each time you make an installment on the payment. So it's much easier, or it's much flexible for us to reduce the debt than it is for us to reduce the equity. The other advantage we benefit is the cost. The cost is limited to interest payments for the particular amount that we've taken, and maybe the periods that we have agreed upon with the finance provider. So we can budget. If we've taken the loan for 5 years, we know that the interest per year is like this. But usually long-term debts, the interests will be favorable. They will not be too much. They may be a little higher than the short-term debts, but they will not be extremely so high for a company to be at a very high risk. Then debt is also less costly source of is a less cost source of financing, because the one, when you have debt, you don't pay tax on that particular debt. So remember, when you're doing your financial statement, we have profit before interest and tax. So on that profit, you first less the interest that you're going to pay to the finance provider. That interest is not taxed, so you're able to reduce on your tax liability. And it also helps debt also helps debt providers usually provide us with a lower rate of return, which is different when we have shareholders, or if we choose to do issuing of shares to be able to raise finance. Then the challenges that we'll face, of course, we'll have interest that we will pay, whether we made profits as a company or we've not made profits. This is a must pay for an organization. And interest and principal payments must be paid when they fall due. If we say we have to pay on a monthly basis this particular amount of money, whether you're in operations, whether there's something that affected you, it's very important, or it will be almost mandatory for you to make your deposit on the interest and the principal to remain on good terms with the service with the finance provider. Then terms for debt may contain restrictive covenants that may limit you from having flexible operations. So those are the challenges of having long-term debt. We can also access finance from hybrids. I don't know if any of us has heard about hybrids. Here we can neither have debt entirely or equity entirely. Okay. So with hybrids, I was saying that here we have a financing structure that is neither 100% debt nor it is 100% equity. So for example, we have convertible loan notes and debts with warranty, whereby you can have a loan, and then at the end of the loan you can either choose to either convert into shares or notes. So it means you have it can either be sorry about that. So you can either decide to say, maybe out of my 100%, out of my 100,000 debt loan note, I will convert maybe 100 of them, 100 maybe 10% to shares, and the other will be repayable to me. So you can be able to convert either into shares or maybe make the payment. So on the interest rates on such, the main advantage is that the interest rate on such a source of finance is a little lower, or more likely to be lower than the debt without such options. Why? Because if the person fails to pay debt, it means that now you're going to change the loan note into shares. So you're going to become a shareholder. So the risk of default is much lower. There is surety that if you don't get your money, you will get an equal number, the corresponding number of shares to the amount of money that you offered. So then we also have something called initial coin offering. Anyone who has done financial management and has an idea, anyone, about initial coin offering? Okay, I don't know which example I can give that will be much more easy easy to understand. But with initial coin offerings, before you get registered, there will be, let's say, a number of, okay, let's say, can we get, I can use any coin. Which coin is very common? Ethereum, Bitcoin. Okay, you can say Bitcoin. So before Bitcoin gets registered, there will be a number of, can I say, okay, they call it mining. There will be a number of people or a number of coins that you must have given out, or that must have been subscribed to by the public before it gets registered. So this is they might say each coin is going to be, or even for shares, we say we're going to, each share is going to be at 100 shillings of each, or let's say here we're talking about, for example, on cryptocurrencies. So if the Bitcoin is going to be mined now, or we're now in the registration process, first they will say maybe before we register you, you need to have at least 10 people that have joined, or that have used this Bitcoin, or have bought this Bitcoin, such that we can know that people can be able to trade with it. So you say, my first 10 coins, each coin is going for, let's say, 1000 shillings. So people will come and do the mining or the buying of those coins. Then when you get to that particular limit, then you can be able to have it registered. So you can raise money like that when you're doing the initial coin offering. You give them a coin, in exchange they give you, they make payment, or you receive the money, and that money can be a source of finance for you to run your day-to-day or business operations. So this is more like initial public offering. If you're registering shares, or you're registering yourself to be a listed company, you have to have some shares that must be bought by the public, and up to that particular limit. Before you get to that particular limit, you cannot be listed. So same for the cryptocurrencies. There will be the initial coin offering, which people must where people must have to buy your coins, have them in circulation or in use, for them to have confidence in registering that particular coin for the mode of cryptocurrency. So that can also be a source of finance. Then we can also have lease. Just a second before we talk about lease. Are we together on the initial coin offering? Do you understand it?
Yes.
Okay. Okay, so now let's look at leasing. We've heard about leasing quite a number of times. Anyone who can explain to us what lease is? Anyone? Because now I would expect majority of us to have an idea on what a lease is, because for it it's very common in different papers, be it being auditing, let it be finance. It's very common. On level 2, most papers really have something to do with leases. Anyone?
Let me try.
Okay.
Is, for example, I will try to give an example, or just someone. It can be maybe limited property, while maybe land.
Okay.
So this land might be maybe owned by a person who is a lessor, and this person maybe gives it to another person who is a lessee for a certain period of time, to use that land for a certain period of time. It might be maybe 2 years or 3 years. So this person, the lessee, is going to use this land maybe for those 2 years, or maybe over to do agriculture or to construct maybe a building on that land, but for that period of time. Then maybe it depends now that the lessee might either return okay, decides to use that land for a given period of time, or either the lessee might also decide to buy the land for like completely to own that land. So it depends the type of a lease also.
Yes,
That is what I can say about it.
you're 100% correct. Leasing, that is how leasing happens. We have a lessor and a lessee. The lessor is the one who is giving out something for rental hire, and the lessee is someone who is going to use that particular asset, and they will have a right of use, and they will make lease payments. They could be, let's say, depending on the agreement, maybe monthly, maybe yearly, depending on if it's either a finance lease or an operation lease, depending really. But yeah, we're not going to go in detail. So a lease can also be used as a source of finance. How? If you have a property, you can say, we're not using this property for really significant work, let's give it out to anyone to use, or let's, in simple terms, let's rent it, someone who can use it and give us payments, so we can collect revenue from that asset. You could have a motor vehicle, you're not using it, but you're in a place of finance of limited finances, so you can say, let's use this vehicle, give it to someone, they can use it for, let's say, 1 year, and they'll give us maybe this amount of money per month. So you're deciding to lease your asset to receive rental income in return. So that is how you can be able to generate income from leasing. Then we have short-term finances. These usually finance debts that will run for not more than 12 months. We can call it maybe a year. They can be short-term loans, they can be bank overdrafts. These usually happen for a very short time. So if you can organize with your banker or the bank that you've been using for your day-to-day business transactions, and say, we would like to purchase, maybe we have a shipment coming through, we are short on cash, can you give us an extra, let's say 100 million, to be able to continue with the processing, and then we shall pay you back in let's say 6 months, and then you will get your bank overdraft. The good thing with them is that you will get instant cash. You don't have to go through a lot of procedures, because these are already your existing banking partners, and then it's very flexible. But the difficult about it, or the disadvantage about overdraft, is that they can request for payment anytime, instantly. It's not something that you will say, we will pay over like this amount of money each month for the next 6 months or the next 1 year. Yeah, there could be a demand for money, and then you're required to make your payment in a shorter time than had been agreed. Also, the interest rates for overdraft are usually higher, because they are more risky, since they don't take much can I call it collateral or security. The risks will be, the interest rates will be higher for the company that is taking the bank overdraft. Another source of finance is trade credits. These we are the most common. Trade credit is taking goods on credit. Instead of paying your supplier 1 million today, you can say, we shall keep using this 1 million for other activities, maybe transportation, maybe payment of salaries, or whatever. For this 1 month, we shall be managing with that 1 million, and then we'll pay them at the end of the month. So you're getting money. It's a form of having the money in place before you could pay whoever you're supposed to pay, either they're giving you a good or a service. So those are the different sources of finance. We also have short-term bank loans, which are almost similar to short-term, close to bank overdrafts. These are also usually in the period of 12 months. You go to your bank and then you request for a loan. This will usually require some security. different from the overdrafts. Overdrafts will not have, usually will not have security. Bank loans will have security attached to them, and then you can agree on the principal payments and interest payments on a monthly basis. So these are available for most companies really. They're much easier to get. That's an advantage, and the interest rates are usually not as high as long-term debts and overdrafts. However, the process of getting them is also a little longer, and the costs involved could be high. Maybe you need to get a lawyer, there is insuring of the loan, there is this and that, so the costs may be a little higher than the overdraft, where I don't need a lot of procedures. And other disadvantage is the refinancing. If you have an already existing short-term loan and you want an extra loan, it's difficult. You have to first pay off the previous one. So if you had, let's say, 10 million short-term loan and now you need 20 million, so you will go to your company and say, I need 20 million, and then they will, instead of giving you 20, sorry, your bank and not the company, instead of giving you 20, they will give you 10. The 10 will first cover the previous loan, so it has been paid off, and then they'll give you the balance to be the amount of money that you'll be taking on. So it's difficult to get refinancing. So that is it about the different sources of financing. We said we can have equity financing, whereby we can have ordinary shares or preference shares. What is the difference? Ordinary shares, we have these ones can be paid dividends, or they cannot be paid dividends based on the performance of the company in the period. Preference shareholders, it is mandatory. They have an amount of dividend that has been agreed upon, and you'll have to pay them whether you've made profit or you've not. So it means if you don't pay them now, you will carry forward and you'll have to pay them. Then we said we can also, from equity, we can also use retained earnings. These are savings that we made on the previous years, so we can use it's an internal source of financing. Other external sources of financing that we can have loans, bank loans, we can have convertible loan notes, we can have long-term loans that run for more than a year, we can have initial coin offering for currencies, we can have sorry we can have overdrafts, we can have trade credit, we can have bills of exchange and commercial paper. So those are the different sources of finance. If we are okay, you let me know. If there are any questions, also please ask before we can proceed.
Yes, okay.
Okay. Okay, for the others who don't speak up, I would presume that maybe they're also okay, because it's best important. If you have a query, we address it before we go to the next part of the topic.
But we're not seeing the screen.
Oh, sorry. So we have investment in working capital. This is mainly in finance, but it's best that you understand them. However, don't expect calculations really. So that understand how it could come about. It could help you in decision making, but this will not be. You don't be asked to do computations for most of these things. So I don't want to go into computations, but we can have an idea. What is working capital, first of all? What is working capital? Anyone who has an idea what working capital is in simple terms?
Working capital can be the difference between the company's current assets and current liabilities.
That is its calculation. Okay, well, it can also be a definition, but basically that's how it's calculated. So working capital in simple terms can be how much is available that you can use in your day-to-day running of the business. So that's how we get to it, by getting the current assets and less the liabilities that we have. If we have assets of, let's say, 1 million, and we have liabilities of, let's say, 400, means that we have really what we can use every day to regenerate cash is only 600,000. So in simple terms, that's what working capital is. Then we have something called cash operating cycle. Have you heard of it before?
No.
Anyone who has ever heard of cash operating cycle from financial management? So with cash operating cycle, it's how much time we take for the funds we've used in purchasing something. For example, between, if we made an order for buying inventory today on 1st of March, and then up to the point we will sell and collect that money from the customer, if it is 30th of March, it means that our working capital is 30 days. So how much time we're taking from the point of when we pay for the goods up to the point when we receive payment for those particular goods from the customer. So that's what we call the cash operating cycle. That cycle, or how much time is in between, the time length between the point of you investing in that inventory up to the point of you liquidating that inventory. That's what cash operating cycle is. Then we have non-current assets. This could be tangible or not tangible. These are assets that are, someone complete it, because I think these ones most of us have knowledge about them. Non-current assets are what are non-current assets? Really, what are non-current assets? Okay, in simple terms, non-current assets are assets that we will use for more than one year. Assets that their use can be benefited by a company over time. If you've bought a motor vehicle and you're not a company that deals in manufacturing motor vehicles, so it means it's not inventory for you. It means now that asset would be an non-current asset. You're going to use it for year 1, year 2, year 3, year 4, up to when you decide to dispose it of. So those are what non-current assets are. So they can either be tangible or they may not be, or they may be intangible. Tangible are the ones that we can have a physical touch. They are physical. The intangible, we cannot have a physical touch. For example, things like goodwill. No, goodwill is a current asset. Things like research and development, you might have put into cost into doing research. For as long as you're dedicated or you have in place the requirements for it to be a research and development cost, you can complete it. Results are feasible. That means now that can be an asset until it comes into reality. We have other costs like maybe licenses. You've paid to use but let's say a trademark. You've paid for a trademark for 10 years. That's a non-current asset. You can use it for all the 10 years. That's the difference between the tangible and the non-tangible assets. So this you can they're important for you when you're trying to advise a company on financing, on investment, or even on analyzing the company position. Maybe it could be their gearing position, it could be their liquidity position, it could be the investment position. Those are very important. So we come to the end of our chapter. I don't know if there are any questions. Any inquiries? Okay, since I'm not getting any response, I'll assume that we don't have any inquiries, and we can call it a night. Thanks so much for attending today's class, and have a lovely evening. See you next week.
Thank you.